Welcome to Strictly Money at the News Farm, where all voices matter. I'm Saijal Patel. Many retirees are discovering that they haven't saved enough, that they are likely to live longer than they initially thought, and that the cost of living is well beyond what they believed they'd face. So it shouldn't come as a surprise that more and more senior homeowners are getting reverse mortgages. Watch any commercial and they'll sell you on the upside, that you don't have to make any payments and you can stay in your home for as long as you like. But like any sales pitch, they don't tell you about the downside. And there are risks you need to be aware of. To discuss what those are is Shokhrukh. He is Vice President, North American Financial Institutions at DBRS Morningstar. Shokhrukh, great to have you on.
Good morning. Thank you for having me today.
So Shokhrukh, home equity is one of the providers of reverse mortgages, and they've said that they've surpassed $1 billion in loan originations 2 years in a row. So we're certainly seeing demand up. Is it driven because of an affordability issue? So people are pulling money out to sustain their everyday living, or do you think this is more of a lifestyle issue problem that seniors want to stay in their home?
Right. The reverse mortgages in Canada gained popularity in recent years for different reasons. So seniors tapping the utilizing reverse mortgages to cover, for example, living expenses, to make the renovation in their properties, to pay debt, credit cards, as well as to provide early inheritance to their children. So among those factors, actually more common reason why they are actually utilizing reverse mortgages is associated with their desire to provide early inheritance to their children. So it's more about actually their children's financial needs rather than their own financial needs. As you know, owning a property in Canada becoming less and less affordable in recent years, particularly in GTA and GVA. So by utilizing this product, seniors providing early inheritance to their children so that they can actually make down payments for their own home purchase. That's more common reason actually we're observing in the market.
That's really interesting. So let's step back, and can you just explain how reverse mortgages work?
Right, so reverse mortgages is a specific product tailored for seniors age 55 and above. And essentially, it's a product secured against the borrower's primary residential property. So you have to live in the property at least 6 months in a calendar year in order your property remains eligible for the reverse mortgages. So reverse mortgage is not amortizing debt, rather it's approved for life, and principal is repaid whenever loan becomes due. And also, you're not required to make the periodic interest payments. So interest payments also accrue over the tenor of debt, which means that when loan is due, the loan balance could have grown a lot compared to initial value at origination.
Yeah, and that's the part that I wanted to talk about, because I just want to make sure viewers do understand the risk. So how big of a risk is it for homeowners? Say they take out $200,000, right? And they don't pay it back for 10 or 20 years, and that interest accumulates. And we know that interest is somewhere around 7 or 8%. So, it could be a lot to owe.
Exactly, you're right in that sense. So if you take your example, for example, even though the reverse mortgage is approved for life, it could become due anytime depending on the trigger events. For example, it could become due in 1 year or 20 years. So let's say during the tenure of 20 years, you're not making any payments on principals or interest rate, which means that in year 20, your loan balance might have grown a lot. But the risk actually is more on the lender side rather than borrower side. So if you take the extreme case whereby, let's say, the loan value exceeds the property value, fair value, when the loan becomes due, in that case, the shortfall actually is a loss for the bank. So bank wouldn't have recourse to borrower or his or her other assets in such case, as long as borrower is not in technical default.
Okay, so that's really interesting. So the lender actually is the one that takes the greater risk in most cases. We're going to take a quick break, Shokhrukh. We'll be right back. Welcome back. Shokhrukh, before the break, we've been talking about risks when it comes to reverse mortgages. The risk for the borrower or the homeowner would be, I guess, that they default, right? What could trigger that? Let's go through that.
Right. So default scenario for reverse mortgages is different from conventional mortgages because as a borrower, you're not required to make periodic payments. So the default scenario includes the circumstances, for example, when the borrower cannot stay current on property taxes or cannot pay in time home insurance, or they can't maintain the property in good shape. So these are the common default trigger scenarios, even though there could be other specific scenarios dictated by the lender. But they are the common scenarios. If you take, for example, property tax, if you can't stay current on your property tax, municipality government would take over the ownership of your property and would perform a tax sale of your property. So technically, in that case, you would seize ownership of the property, which is one of the trigger that for the loan to become payable or to be repaid.
Okay. I know you can stay in your home as long as you like. You know, this is one of the selling points when it comes to reverse mortgages. And I guess you're lucky if you can. But if you do, suppose you go into a long-term care home, what happens? Or even if one of you and the other spouse doesn't go, what happens?
Right. So there are different trigger events we call for the loan to become payable or to be repaid. And actually moving to long-term healthcare facility is one of those triggers. So what happens is that if the borrower decides to move to long-term healthcare facility, he or she has to actually repay that within certain period after moving to healthcare facility.
Okay. Can you borrow? It says that you can borrow up to 55% of the current value of your home. I suppose that actually does depend on a lot of things, right? Can most seniors access that amount, or what's the average amount?
Right. So I think it's very case specific, and actually every lender had their own criteria in terms of how they underwrite and which factors they take into consideration before approving the loan. But one of these things relates to actually discount factors. So depending on where the property is located and type of dwelling, whether it's a condo or a single family or detached family, how there could be different discount factors applied to fair value of the property before the approval. And in certain cases, for example, if the property is located in some of the remote areas of Canada, with the fair value being less than certain amount, your property might not be even eligible for this loan. So that's why the borrowers should work with lenders to discuss the specific nuances and circumstances.
Oh, that's really interesting. So it really does depend on location. Is that because of maybe the marketability of the property in the future?
Indeed. So like in Canada, GTA and GVA areas considered more liquid, deep market, and so marketability is not really an issue. But if you go beyond those areas to more remote areas in Canada, liquidity and marketability becomes an issue. And to account for that and to mitigate such potential risks, lenders actually apply different discount factors.
Okay. Now, EQ, I think EQ Bank is one that also offers it. There's only two providers. Are they different? Do they offer the same type of product?
Right. So there are mainly two providers in Canada. for reverse mortgages. The largest one is actually Home Equity Bank, and the second lender in terms of size is EQ Bank. So the market, the competition is not high at this moment in Canada, but EQ Bank is also looking to expand the portfolio. So we're expecting sort of competition as well to increase in coming years. So in terms of products, they're very similar, and I would expect the underwriting standards and criteria as well to be very similar because both banks are regulated by OSFI.
Okay. Shokhrukh, we really appreciate your time. Thanks so much for coming on and your insights.
Thank you for having me today.
Shokhrukh Chabarov, DBRS Morningstar. Stay with us because when we come back, we're going to be talking about the housing market and whether you should go fixed or variable when it comes to your mortgage.